Start with upbeat background music. Show an animated intro with the title, How to Invest for Beginners, 2025. Cut to the host, you or an animated character standing in a cozy, modern setup. Use minimal, clean graphics and floating text with key phrases as you speak. Script, approx. 2,500 characters. Hey everyone, welcome to the channel, and if you're new here, make sure to hit that subscribe button, because today we're diving into one of the most important topics for your financial future, how to invest for beginners in 2025. Now, let's be honest. Investing can sound intimidating. You've probably heard people talking about stocks, crypto, real estate, or maybe even the term passive income, and it all sounds like a secret language. But don't worry, I've got you. This video is made specifically for beginners. No complex jargon, no financial degree needed. Just clear, simple guidance to help you get started the right way. So, why should you even care about investing? Because saving money alone is not enough anymore. Think about it. If you put your money in a regular savings account, it might grow by 1% per year. Maybe. But inflation? That's growing at 3, 4, even 5% some years. That means your money is actually losing value just sitting there. Investing helps you stay ahead of inflation and grow your wealth over time. And here's the best part. You don't need to be rich to start. Whether you have $100 or $10,000, there's a way to invest that fits your budget. You just need the right mindset, some basic knowledge, and a long-term plan. In 2025, investing has never been more accessible. With apps like Robinhood, Webull, E-Trade, and others, you can start investing right from your phone. No need to wear a suit, talk to a broker, or read the Wall Street Journal every morning, unless you want to, of course. In this video series, I'm going to show you exactly how to begin, step by step. We'll talk about the different types of investments, how to choose what's right for you, how to manage risk, and how to avoid common beginner mistakes. By the end of this, you'll feel confident enough to make your first investment or improve the strategy you already have. So, grab a notebook, stay focused, and let's start building your financial future. One smart investment at a time. Ready? Let's go. Show 2 animated characters. One starts investing at age 25, the other at 35. Display their investments growing over time with simple bar graphs or charts. Use visual cues like calendars, clocks, or plant growth to show the power of time. Script, approx. 2,000 characters. Let's talk about one of the biggest secrets to successful investing that most people overlook: starting early. A lot of beginners think they need to wait until they're older, or until they have a lot of money saved up. But the truth is, time is more powerful than money when it comes to investing. Let me give you a simple example. Imagine 2 friends, Alex and Sam. Alex starts investing at age 25, putting in just $200 a month into a basic index fund. Sam waits until age 35 to start, but invests $300 a month to try and catch up. Now, fast forward to when they both turn 60. Even though Sam was investing more each month, Alex ends up with a lot more money because he gave his investments 10 extra years to grow. That's the power of compound interest. Compound interest means you earn interest on your original money and on the interest that money makes. It's like a snowball, rolling down a hill, getting bigger and faster as time goes on. The longer it rolls, the more powerful it becomes. So, if you're in your 20s or even your early 30s, this is your advantage. You don't need to be rich or take huge risks. You just need to start now. Even small amounts, like $50 or $100 a month, can turn into something big over time. And don't worry if you feel like you've started late. It's never too late to begin. The best time to plant a tree was 20 years ago. The second best time is today. Remember, in investing, Time in the market beats timing the market. So don't wait for the perfect moment. Start with what you have. Keep learning and stay consistent. Your future self will thank you. Use clean animations or icons to represent different investment types: stocks, real estate, ETFs and mutual funds, bonds, and cryptocurrency. Use simple charts or risk meters to show the difference in risk as reward. Script, approx. 2,000 characters. All right, now that you understand why starting early is so powerful, let's break down the different types of investments you can choose from. This is where things get interesting, because not all investments are the same, and understanding your options is key to building a smart portfolio. Let's start with the most common one. Stocks. When you buy a stock, you're buying a piece of a company. If the company does well, the value of your stock goes up. If it performs poorly, it goes down. Stocks are great for long-term growth, but they can be a bit risky in the short term because prices can swing up and down quickly. Next up, ETFs and mutual funds. These are collections of many stocks or assets bundled together. Think of them as a basket of investments. The big benefit here is diversification. Your risk is spread out. For beginners, ETFs are a great starting point because they're low cost and you don't have to pick individual companies. Then we have bonds. Bonds are like loans you give to companies or governments. In return, they pay you interest over time. Bonds are more stable than stocks but usually offer lower returns. They're great for balancing risk in your portfolio. What about real estate? Investing in property can bring rental income and long-term appreciation. It requires more money up front and management, but it's a solid way to build wealth if done right. And finally, there's cryptocurrency. This is the newest and most volatile asset class. Bitcoin, Ethereum, and other cryptos have made headlines, but they come with high risk. If you're interested in crypto, start small and only invest what you're willing to lose. Each investment type has its own level of risk, reward, and time horizon. That's why smart investors diversify. They don't put all their money in one place. In the next scene, I'll show you exactly how to start investing step by step. But for now, remember, knowledge is power. The more you learn about your options, the better choices you'll make. Okay, now you know the types of investments. So how do you actually get started? Don't worry, I've got a step-by-step plan that's perfect for beginners. Step 1. Choose an investing platform. Pick a trusted app or website like Robinhood, Fidelity, E-Trade, or Webull. Look for low fees, beginner-friendly features, and good reviews. Step 2. Open your account. It's just like opening a bank account. You'll need some basic info like your ID, address, and bank details. Most platforms approve you within a day. Step 3. Set your goals. Are you investing for retirement, a house, or just to grow your wealth? Your goals will help determine your strategy and how much risk you're comfortable with. Step 4. Decide your budget. You don't need a lot to begin. Even $50 a month is enough. The key is consistency. Invest a little every month, like a habit. Step 5. Choose what to invest. And for most beginners, a low-cost ETF like an S&P 500 fund is a smart place to start. It gives you exposure to hundreds of companies with one purchase. Step 6. Invest and monitor. Buy your first investment, then watch it grow over time. Don't panic if it goes up or down. Think long-term. That's it. You've officially started your investing journey. In the next scene, we'll cover some common mistakes to avoid so you can stay on track. All right, now that you know how to start investing, it's time to talk about what not to do. Even smart beginners can make mistakes. But the good news is most of them are easy to avoid once you know what to watch out for. Mistake number 1. Investing. Without a plan, don't just throw your money into the stock market hoping for the best. Always have a goal. whether it's retirement, buying a home, or building wealth. A clear goal helps guide your investment choices. Mistake number 2. Trying to time the market. A lot of beginners wait for the perfect time to buy or sell. But guess what? Even experts can't predict the market consistently. Instead, invest regularly, no matter what the market is doing. This is called dollar-cost averaging, and it helps reduce risk over time. Mistake number 3. Panic selling markets go up and down. It's normal. But many beginners freak out when prices drop and sell at a loss. Don't let fear control your decisions. Remember, the market rewards patience. Mistake number 4. Putting all your money in one place. It might be tempting to go all in on a hot stock or cryptocurrency, but it's very risky. Diversification is your best friend. Spread your money across different assets to protect yourself from big losses. Mistake number 5. Following the hype just because everyone on social media is buying a certain stock or coin doesn't mean it's a smart move. Always do your own research. If you don't understand it, don't invest in it. Mistake number 6. Ignoring fees. Some platforms and funds charge high fees that eat into your profits. Always check the fees before investing and stick to low-cost options when possible. And finally, don't expect to get rich overnight. Investing is a long-term game.